Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Andy Misiaveg from the East Coast. So we're going to get a little look of the East Coast retail today, which is, I think, going to be very interesting, given that the retail world is in actually better shape than office and some of the other sections of commercial real estate. So Andy, it's great to have you. I just love to kind of hear how you got to where you are now. 25.
Yeah, Bruce, great to be on and listen to a couple episodes. So happy to be honored as a guest and pick each other's brains about what's going on in the retail space for a little bit.
That'd be great. So you grew up in that area?
I did. Yeah, I grew up in the Carolinas, mainly half in Charlotte, and then when I got older, moved to Greenville, South Carolina. My dad was a retail developer, so we worked our way down to Greenville, where he had a new opportunity and job, and then pursued my talents pretty locally over to Clemson University, which is, for your listeners that don't know, is only about a 40-minute drive from Greenville. And got out of Clemson, and my dad, like I said, was a retail developer, and I thought I might want to look at getting into the retail real estate world. So I went out to the lovely ICSC trade show conference in Las Vegas, which is every third week in May, which I will be attending in 2 weeks. And for your listeners maybe not familiar, ICSC is the International Council of Shopping Centers, which is the large retail trade show, trade alliance organization that kind of helps shepherd the retail industry along from a retail real estate standpoint. And it's a very large conference. They have them all over the country, but the biggest one is in Las Vegas in May. So I went out there, and this is a good story, which you'll laugh at. I set up a bunch of interviews on my own. My dad helped me set up a few, and he called the CEO, former founder of the shopping center group, who was then CEO of the shopping center group, my firm, and said, "Hey, my son wants to get in the business. Why don't you meet up with him in Vegas? I'm going to bring him out there." And our CEO says, "Great, have him meet me at the Baccarat table at 8 o'clock in the casino." And so my first interview at the shopping center group was at a Baccarat table at 8 o'clock with our former founder and CEO. And I guess he liked me enough, because the next night I interviewed with the managing partner of our Carolinas group, which I'm still a part of, at the blackjack table, or no, at the roulette table. So I came back and thought, wow, these guys really like to have a good time. They don't take themselves too seriously. And they offered me an opportunity to start here in the Carolinas. And my dad thought really highly of them. So, and had done a lot of work with them. So it made a nice match.
So I'm curious, did you end up having to gamble with them as part of your interview?
I did. And this is an even funnier part of the story. Thank you for reminding me. So at the Baccarat table, I mean, that was a higher limit game, so I did not get any money to gamble there. But at the roulette table, I think I had some money that I had saved from college that I gambled with. And as you know, your money can go a long time in roulette if you're managing it the right way. But my dad didn't have any cash on him, and he kind of sat there while I was being interviewed, just hanging out gambling. And the guy that ran our group in the Carolinas, I think, lent my dad $300 or $400 to gamble with. And my dad proceeded to lose the money during my interview. And so the next day, the guy called my dad and said, "Hey, you owe me $300 or $400. And he goes, "What are you talking about?" And he goes, "Well, I was interviewing Andy, and I gave you some money." He goes, "I would never gamble in roulette." He goes, that was just an advance on Andy's salary. He goes, "What idiot would ever play roulette?" And so the story's kind of become a legend now, but it was pretty funny at the time. He did not pay him back.
Yeah. Well, those were the go-go days of interviewing at roulette tables and baccarat tables. That's
right. So I think he just penalized me even more on my starting salary that first year as a way to offset the roulette loss.
So you've now been at it for how long?
So 25 years at the shopping center group. We're headquartered out of Atlanta. I'm a kind of co-managing partner here in the Carolinas group in the Charlotte office, and I'm a one trick pony, as they say. I've never worked anywhere else. Same group for 25 years since I got out of Clemson. So I wouldn't even really know what to do if they threw me out. I'd probably be sweeping floors somewhere.
Well, you seem to have done okay there. Well,
It's
who are you representing these days?
Yeah, it's been great. I think that's the one thing that always changes is, retail is always changing and evolving, and so are the tenants. We've got a great crop of tenants that we work with currently, all the way from, the Great Clips of the world, all the way up to Costco and Topgolf and everybody in between from a size use standpoint. I'll tell you that the sectors that are really growing right now are a concept you might have heard labeled before called Medtail, which is a lot of these medical tenants that want to go into retail spaces to increase their profile and develop a bigger, presence. So the Aspen Dentals of the world, Vision Works, the urgent care groups, all of these guys that traditionally went in the rear of a medical office building or in a medical park somewhere. A lot of those tenants right now are out there growing and going at the forefront of the retail project so they can really increase their exposure to the local population and as opposed to kind of a mom and pop strategy which they used to go with on their real estate.
Well, and Top Golf has gone completely crazy, right?
Yeah, the entertainment sector is really the other sector that's been growing substantially since COVID over the last 5 or 6 years. Topgolf was one of the leaders in that, along with the traditional movie theater venues. But I mean, there's so many of these guys that are out there growing now. You've got Flight Club, which is a interactive dart concept. You've got Putt Shack, which is kind of an indoor digital putting concept. You've got F1 Arcade, which is based on the Formula One simulators. Meow Wolf, which is kind of a crazy interactive
Oh, I've
art
been there.
escape
Yeah.
room. You know, Sandbox VR, Beat the Bomb. I mean, Escape Room. I mean, there's just so many of these entertainment concepts that are out there growing right now, and have a lot of private equity behind them to grow. And so we've spent a lot of time the last 3 or 4 years trying to work with those concepts to grow. And it's a bit of a different model. They're not looking for a traditional shopping center space. They're looking to be more where the nighttime activity is and other entertainment activity is. So it's a bit of a different space requirement, but that's real active. Medtail is real active. Obviously, the restaurant space is still extremely active. So we're working with a lot of different restaurant users, some that are mature and continue to grow significantly, like the Chipotles of the world. We've got a really busy pipeline with them, and then others that are new to the market, like the Raising Canes, Dutch Brothers Coffee, Portillo's. I mean, a lot of concepts that are coming into the market right now that have a regional or national presence that are looking to expand into the Carolinas.
Are you getting any of the Claw Arcade guys out there? You
Not
don't know that
yet.
one? Not
I've,
yet.
I've, I've,
Okay.
I've seen a couple of them or heard of a couple of them, but I haven't seen many show up here on site plans or being out there marketed yet. But I'm sure it's coming.
Yeah, I'm sure it's heading your way because it seems to be a very profitable venture out there. So that is just it sounds like it's a crazy world right now. So in terms of Chipotle and some of the national tenants, are you doing just local work or are you doing national work with them?
Most of the tenants that I'm responsible for, we're working with mainly on a Carolinas distribution basis. We as a company have some concepts that we work with nationally and regionally as well. But my local expertise is really here in North and South Carolina. So I spend probably 95% of my time working on deals around here. We've had some clients where we've worked a little bit more regionally, dipped into kind of Tennessee, Virginia, Kentucky, Georgia, Alabama a little bit, but 95% of the time it's kind of focused here. The Carolinas is not as large as California, obviously, but it's 16 million people when you combine North and South Carolina. So when you combine the two states, it's about the fourth largest geographic area in the country from a population, behind Texas, Florida, probably New York, California. So it's right up there from a population standpoint.
So in terms of a national representation, it just becomes harder and harder to find the locations, right? Because you're just not as familiar with the geography and the locations that are out there.
That's correct, and it also becomes challenging too because you kind of have to make a choice from a travel and where you spend your time standpoint, if you're out there kind of putting your eggs in the broader national tenant basket, then you're out there on the road with them. You're flying to different markets all over the country. Your landlord profile is a little different. You're focused on the bigger mall landlords and the bigger REITs. And so you kind of have to, it's hard to do both. You kind of have to choose one basket or the other. And because if you're trying to really spend your time doing it the right way on a national rollout basis, it really limits what you can do locally. And then vice versa, if you're spending your time locally, it limits your decision making time to go spend time nationally. So that's traditionally what we've tried to do.
Yeah, I mean, I would think. Oh, you flipped your. There we go.
Sorry.
Anyway, I would think that it would become very difficult unless you were, CBRE or JLL or some national firm that to represent Chipotle nationally or any other firm just becomes a difficult task.
Yeah, you've got to really dedicate a lot of resources and time and human resources as well, not just financial and technological, but also human resources. And the larger the program is that you have to handle, the more either more deals or more geography that they want you to handle, it just spreads you and your staff and your time more thin, or you've got to go grow a bigger team around you to handle that, and then you're kind of managing the team. So it's just both can work, but you kind of have to pick one way or the other. It's hard to do both.
So are you saying that you do both in your firm or you mainly stick to local?
I mainly stick to local. Our firm handles some national, but that's not really my platform, which I tend to focus on. The most I've really done is more of a Southeast program for somebody, and they were not doing many deals. It was more focused into small areas.
Yeah, yeah. Well, that makes sense. I mean, you kind of have to go more for the low-hanging fruit than trying to start something new. So
Yeah.
what's your crystal ball saying these days?
Right now it's tough. The occupancy is about 96, 97% around most of the country in the top 50 markets. And as you might expect, most of that is congregated into the better areas where people want to be. So a lot of these better areas, there's almost no true vacancy that's out there being shopped on the market. Some of the less desirable areas have a little bit of vacancy. We are seeing that change a little bit on kind of the junior and big box side with some of the bankruptcies this year. You've got, Big Lots that's been kind of reclassified and sold. Joann Fabrics, American Freight, Party City. So you do have some closings that have occurred that are hopefully going to open up some junior and big box space. Rite Aid, I think, just announced a fairly large reduction in fleet as well. So you are starting to see more of that in that, call it, 8 to 40,000 square foot range. But when you get down in the smaller store range below, 6,000 square feet, there's very, very limited opportunity out there. And then the challenge too is, as you know, it's not cheap to build. Land is not cheap. Entitlements are hard to get. So it's really hard to develop much new inventory unless you get really further out into the suburbs. And most of that is being geared off of grocery anchors. A lot of the grocers are out there chasing rooftops where there is new growth around the country. So there is some opportunity for new development and new space with the grocery anchors that we're seeing.
So are you seeing a trend towards, mom and pop shops coming out? You probably don't deal in that small a field, but out here it seems like there's just been a huge plethora of mom and pop people coming out of COVID thinking that they're going to start a, restaurant or some other retail type store.
We saw a lot of that really through 2022 and 23 when people were really going through a lot of job transition and kind of uncertainty with their own kind of personal future and employment future and looking at different options. I would say it's slowed down a little bit in the last 18 months because the cost to borrow, if you are going and get an SBA loan or you're trying to go get your own commercial loan to open up your business, those costs are higher. People have gotten a little bit more comfortable again with whatever their place of employment is. So I would say we've seen a little bit less of that. It was really hot for a couple years, but we've seen less of that over the last 18 months. But there is still pretty good demand for people wanting to be an entrepreneur and kind of take control of their own destiny and run a business. But as you know, it's not nearly as easy as everybody thinks it is. So you do see quite a bit of failure in those mom and pop categories. They just don't know. You don't know what you don't know, and you get into a business that you think you know how to run, and you don't have any experience in that segment, and experience working with on the ground personnel in a store or whatever the place of business is, and it can just be very difficult. So it's not for the faint of heart, and most people that do it really have to lean into that as a full-time job versus passive income. I mean, you've really got to be in there on the business trying to work it every day to really get those businesses and retail stores and restaurants to grow.
So I'm curious, you were talking about financing, and has that played a factor for the bigger boxes at all?
It has, both in terms of the cost to build out their spaces is so significant now, with construction costs and their furniture, fixtures, equipment. You've got the tariff situation coming into play where they're trying to forecast, what kind of fixtures, furniture, inventory, equipment that they're going to need over the next 12 months. So they're looking at those kinds of budgets for what's coming in overseas. So that cost has gone up, and then the financing costs with interest rates over the last 18 months have gone up as well. So a lot of lenders have really tightened their requirements on loans, be it not only just the interest rates, but who they'll underwrite to, how much they'll underwrite for you, what they're looking for as far as collateral or some sort of a personal guarantee. So it's all just become more difficult to get the capital, more difficult to project out what your costs are going to be over the long term, especially with some of the uncertainty on the tariffs right now.
How many of your landlords are really hammering down on personal guarantees these days?
I would say, you mean on leases with tenants?
Yeah, yeah.
It just depends on the balance sheet and the tenant operator. I would say that most of them are giving some sort of a limited personal guarantee, somewhere between 2 to 5 years of the lease. And that's really to cover any tenant improvement dollars, any kind of brokerage dollar investment that's in the deal, maybe some downtime on the leasing. So normally what we see, obviously a corporate lease is a corporate lease and the corporation guarantees that. But when you're talking about a smaller business owner, it could be anywhere between 2 and 5 years, and then they maybe have a rolling 12-month guarantee after that, so they can't just walk away without any repercussions if the landlord were to pursue them. So it's some sort of a limited personal guarantee that most landlords are requiring on leases still.
So what's the balancing act between the landlord and the TI costs and rent? So are rents going up because construction costs are going higher? What's happening there?
Yeah, the rents are definitely peaking for a number of different reasons. I think number one, what we talked about in the beginning, which is really the major factor, is just the lack of inventory and lack of space. So, a lot of landlords are in a positive position where maybe their center's 99% lease and they have one space. They can afford to be picky. They can afford to wait for the right tenant or wait for the right deal structure or position different tenants against each other in the negotiation to try and get a better deal structure. So part of it is the lack of inventory. Part of it is just in general, the market rents are going up because the cost to build new construction are so significant. So you don't have new inventory coming online either. So you've got, full inventory for what's out there, no new inventory coming online in most areas, especially mature areas. So that I think those are the real factors that are driving up the rents. And in general, also the cost to do business are going up. I mean, your property taxes are going up, your insurance costs are going up, your common area maintenance charges are going up. So even though the base rent might stay the same or go slightly up, you're still paying a much higher factor when you factor in all the costs associated with getting open and your overall charges.
The net charges are skyrocketing or going up. I mean, how many of your leases end up with a cap on expenses?
As a good tenant rep broker, I try and get it on all of them, but in general, I would say on CAM, most of the time you're not going to get any expense cap on taxes and insurance. You might get a first year kind of all in number just so somebody can have a rough budget. But in general, you're going to end up having to pay whatever the taxes and insurance costs are. Sometimes you can negotiate where that it can only go up a certain amount over the life of the term. Basically, which means if the shopping center continues to get retraded and reassessed, at some point the taxes would cap out on the tenant level. Those are harder to get, but we do see that. But on the common area maintenance, on the CAM charges, we usually see annual increases of around a max exposure of 5%. And then you kind of end up negotiating whether those are cumulative or non-cumulative over the life of the lease. It just depends on the tenant and the deal. But normally you try and cap it at 5% per year. And we get that on 80% of the deals, I would say.
So are most big tenants looking at 10 years with options, or what's happening in the market? Yeah.
Yeah, I would say most tenants, if they want any leverage to be able to get any kind of TI dollars or free rent inducement, they're really looking at a 10-year primary term. Some of the freestanding kind of restaurant out parcel users are doing 15 years, maybe 20. Some of the bigger boxes that are going to really drive a whole development, like a grocery anchor or a Target or a Walmart or somebody like that, if they're leasing space, they're usually looking at a 20-year term as well for primary term. And then options are kind of all over the board. In general, the lease that you see is normally matching up the primary term with the option. So if it's a 15-year primary term, you're getting 3 5-year options for 15 years. But a lot of the bigger tenants have enough demand and control over their leases where you might see a 15-year lease and they've got 6 5-year options or 8 5-year
Oh,
options
wow.
because they,
Oh,
they
wow.
want control over that lease long term in that space because they're committing a lot more capital. It just depends on the deal.
And how many of those are at fair market value? Some not.
Almost none. I mean, the
Oh,
bigger the bigger the bigger
yeah,
tenants are pre-negotiating those option bumps, and they're usually somewhere 5 to 10% every 5 years.
yeah,
So
yeah.
you've kind of pre-negotiated those ahead of time. Uh, Sometimes you can agree if they're really further out. So maybe, let's say in that example I use, it was a 15-year primary term and 8 5-year options. You might have 4 of those 5-year options or a set rental increase, and then maybe they might be fair market value at the end. But the fair market value is always tricky because nobody really has any leverage, and it opens up a really broad based conversation of uncertainty for both the tenant and the landlord. It's always tricky to determine. We try and encourage both tenants and landlords to stay away from that and try and lock in something so you can project out your rent roll long term.
You put windows in for fair market value sometimes?
You can, yeah, we've seen some windows, but at that point you're better off just saying let's both agree to a percentage or a number and cut the mustard and let's go.
Yeah.
So try not to do windows. It's either
Too
it
difficult.
still leaves too much uncertainty. You're better off just saying fair market value at that point and dealing with it when it comes up.
How about theaters? What's happening in the theater world out there?
It's tough. I mean, most of the theaters are built as a single purpose building, and a lot of them are dated. You haven't seen a lot of theater development in the last 7 or 8 years. So the theater industry is changing, especially with the new technology, the technology that they can build into the seats, into the movie experience. But that costs a whole lot of money to renovate those theaters. So it's tricky because they cost so much to build in general. And then if they want to stay, they're looking for cost to help remodel and cost to get them over the next hurdle. And the theater volumes aren't what they once were, so the theater chains are also having to work on activating those spaces if they don't have a big movie coming in. So a lot of them are trying to figure out, can we do event space? Can we rent it out to a local school, 2 of these theaters a week? And so they're trying to come up with various ideas to activate getting more people in the door and monetizing the 4 walls of their box. And it just costs a lot to operate those and to renovate those to the standard to get people out of their couch and into a theater. I mean, think you've got an 80-inch screen sitting in front of you with 4K technology. and and you've already paid for your streaming service or your cable or whatever it is,
Right.
it takes a lot to motivate somebody to go in and have the theater experience, and the theaters have to really deliver on all cylinders to get everybody to keep coming back to see the movies.
How many are converting to kind of the dinner or food model?
Not as many as you think. A lot of people went through that model, and I think they found out that they're better off operating as a theater and not a restaurant. We have seen some that'll have a bar, but they try not have a full restaurant. So if they can go get a liquor license and it's not too costly or too prohibitive, some of them might have a bar where you can have a drink or bring a drink in. But running the full service kind of restaurant model is really tough, and it's hard to be great at that and great being a theater operator, and it just costs a lot of time and people and human resources to run the restaurant side of the business.
So it sounds like for, well, smaller spaces, you're getting into some bidding wars.
Absolutely, yeah. I mean, we're seeing market rents really higher than we've ever seen. You're seeing a lot of demand for space. Landlords having quite a lot of options for their better spaces in their center. If you've got a prime end cap that's sitting up on the road and it's got great visibility, I mean, you're going to have a laundry list of tenants that have good credit that want that space, and you're really going to be able to kind of work through and dictate some best case terms on those deals. So it just depends on the location, just like anything else. Location, 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 and retail is so space specific. Each space functions and gets merchandised differently within a retail center. So, each space can kind of really vary, but in general, what we're seeing is really all the rents in general have gone up over the last few years and continue to creep up as well.
So I know this is a pretty much an impossible question to answer, but what would you say the average rental rate is for, say, a whatever average size space, 3,000 square feet?
Yeah, I mean, obviously it depends on the location and the center, but if you're looking in kind of the higher profile areas, and I can only speak for the Carolinas. I mean, obviously, Midtown Manhattan is going to be different, and Rodeo Drive in Beverly Hills. So those are a whole lot different rent comps. But what we're seeing in general around the Sun Belt, around the Southeast, is the better areas, and these are non-mall rents. Mall rents are a little different because you're baking in so many charges and there's so many trips that are going there. But when you're talking non-mall rents, we're probably seeing the best centers cap out in the $60 to $70 a square foot triple net range annually, and those are really the best. I mean, the next tier down is in the upper 40s, and that's kind of, and then if you get into the grocery anchored stuff, you're really seeing stuff in kind of the low 40s, I would say, across the board per square foot. And then obviously, if you get into the B and C type rental rates and centers, then that drops down another tier. But I would say the top tier grocery assets, you're pressing close to $50 a square foot triple net. Some of the better specialty centers, or really high end kind of Whole Foods lifestyle type centers are pressing into that $60 a square foot range triple net.
That's interesting. So that's about the same out here, I would think. I mean, the numbers are seem to be pretty close between the two areas. So that's interesting. And cam charges, I know they can run all over the place, but what would sort of an average number be?
I mean, we're seeing cam for grocery anchored centers probably $3 to $6 a square foot. Some of the real nice ones where you've got a lot more landscaping and a lot more fountains and security, you might run those up into the $10 to $11 a square foot range. And then property taxes are kind of all over. It just depends on the municipality, but in general, I would say anywhere from that $3 a square foot to $10 range, depending on the quality of the asset. Is it a single tenant deal? Is it a larger shopping center? So in general, we usually see full triple net budgets for like a grocery anchored center somewhere in the $6 to $10 a square foot total range. For some of the nicer kind of lifestyle, really, really kind of high profile, high fashion type centers, you see those push up $15 to $20 a square foot for total triple net charges.
Oh, wow, 20. Yeah. Well, that I was going to initially say it sounds like property taxes are probably less expensive out there than back here,
I
but
would think so, yeah, a little
yeah,
bit.
and of course, land prices and building prices are probably higher here. But it's intriguing that the numbers sound pretty close to the same. So
Yeah, and I
anyway,
think a lot of that goes to, I mean, tenants, it doesn't really matter where they are. I mean, they have an average unit volume and they can only project to a certain amount of volume. And, that can go up and down based on demographics, especially population density. But in general, unless they have a crazy high margin, like a jewelry or electronics store, which has just huge margins, or, some crazy high profile bar or nightclub, I mean, they're kind of all constrained within their normal variables of what they can pay and what they can project in sales because they're trying to all hit a occupancy ratio based on sales to rent.
well, so that brings up an interesting question. How many people are doing percentage rents these days?
On the retail side, you almost never see it. Maybe less than 10% of the deals. On the restaurant side, I would say you see it. Some of the national guys won't agree to pay it because they're just confident in what they're going to do, and they're paying usually a higher rent anyway. But on the regional and local restaurant deals, you see it in probably 2/3 of the rent structures, and some of them are natural breakpoints and some are set artificially. It just depends on the tenant and how much they think they're going to project in sales.
Yeah, it always seems like a stretch to try and, you know, you got to make sure that you get that percentage rent and how do you verify it and all those great accounting things. But anyway, a difficult
Yeah, we
problem.
we try and encourage our tenants if they do want to agree to it as kind of a sweetener on the deal. And the same with landlords. It usually becomes an artificial break point, um, to where the landlord says, "Okay, I've invested some TI in your deal or your business. We're partners for lack of a better term, and we'd like to see some return if you kind of blow out your pro forma and do really well." And so you kind of set an artificial break point that's probably higher than what their national sales average or regional sales average is. But if they do really well, it's not really going to affect their bottom line if they
Oh,
give off a little bit of percentage rent and everybody kind of gets rewarded. So it happens about half the deals, probably something in that range.
mostly in the restaurant world.
Mostly the restaurant world, yes, because their sales averages are higher and a lot more variable than in the retail space.
Yeah, yeah. Well, this has been an amazing, interesting, fun conversation. I think we could go on for another couple days, but I think from here, how can people get a hold of you, Andy?
Yeah, absolutely. At the shopping center group. So tseg.com is our address, TSEG being the acronym for the shopping center group. And then you can find me on my LinkedIn profile, Andy Misiaveg. And other than that, I'm at my desk grinding away deals and touring with clients every day. So
You're out
find
there.
me in my email address, andy.misavig at tseg.com, and happy to answer any questions from any of the listeners out there.
Well, they will be coming to you, I'm sure, particularly if they're looking in the East Coast world. I think you're the guy to talk to.
Well, like I said, I don't know how to do anything else. I'm maybe not good for anything, but I am confident in what I can do in this space.
I think this podcast was proof of that. So very good to talk to you. I look forward to talk to you again in the very near future.
Sounds great, Bruce. I appreciate the time.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.